Welcome to the Mortgage 101 podcast with Anthony and Manley.
Welcome back to the Mortgage 101 podcast with Anthony and Manley, the show that helps you cut through the noise, understand the process, move forward with confidence in any market. Let's get into it. Howdy, folks. Welcome to the Mortgage 101 podcast. I'm here with my friend Anthony Valentino, who's out in Hawaii. I got my studio producer here, Kevin Hansen, in the background. Kevin, say hi.
Hello, everybody.
And then myself, Manley Haynes, co-host here with Anthony. And we're going to have some fun today and talk about all things mortgages and try to get you some information that you may or may not want to hear, but we're looking forward to it and going to disseminate what's happening in the market a little bit. There's some volatility happening out there. We're going to talk through some of that. We're going to talk through what home buyers are doing today and the properties that they're looking at and what they'd like to be looking at and what they don't have available to them and why that's happening. A lot of things like that. So here we go, Anthony. I'm going to come right at you. What are these home buyers doing today? They are wanting these perfectly ready, finished homes, and they're not available. So what's happening? Why is this happening, and why is this occurring, and what are we evolving into?
First, I need to comment on how beautiful your attire is today. I mean, the glasses, the red shirt, the red cord. I mean, man, that is fire. You are just, it's like you woke up and you're like, I am matching Manly. So just need to throw that out there.
Appreciate that.
Yeah, man. It's a different market, right? The market of having multiple options of different houses and a plethora of options are gone. All those people are sitting with rates in the 2s and 3s. They're the ones that are like, sucker, I got the pool, I got the backsplash, I got the travertine, and y'all going with the carpet and the tile countertops. And the thing is people are now having that come to Jesus moment that they're going to have to put sweat equity into something if they want to buy something now, unless you're going to pay a premium, which is very hard to come by. So yeah, I mean, people are having to settle, which is what we were telling them 12, 15 months ago. If you don't buy now, you're going to settle. And if they think they're settling now, right now, they can at least buy in the same area, in the same school district, in the same, shopping district. There's going to come a time in the next 6 to 12 months tops where now they're going to have to go, we're going to have to move outside of our comfort zone and move in a different area because there's just nothing that we want or want to settle on. That's coming.
What's causing this, Anthony? And how can we get out of this mess?
It's simple. It's due to all the artificial sugar that's in the drinks. That didn't make any sense. And that's why I'm making a reference of it, because it doesn't make sense of what's going on right now.
Yeah.
Historically, you would think that with rates super high, that would create the demand to go down and the supply to go up. And so everyone was like, chomping at the bit going, with these rates going so high, I'm going to have so much options. And now they're like, well, crap. No one's selling, because why would they when the rates are in the 2s and 3s? And no one's building. Builders are now pulling permits based off of houses that have deposits on it. This is not 2012 or 2015 where they would pull hundreds of permits and just hope and pray that they would be sold. They're not doing that anymore. And so it's doing two things. One is keeping the supply and demand in check. There's a lot of demand and there's no supply. And as these rates start tipping down, that's not going to look any better. If anything, it's going to look worse. And it's all because the fact that we have a housing shortage, we have historically high rates that are going down, we have demand that's now going up, and we have people who are hunkered down, not wanting to sell until rates get back down to the 4s, which you and I know won't happen for the next 24 to 36 months.
Ultimately, there's a lot of people that are hanging on to very low rates and they are not going to let them go. You're not going to pry it out of their cold, dead hands unless they have no choice. They have a life change, a job change, or something of that nature that's creating that moment that, okay, well, the house is coming for sale and it's a great opportunity. Or there might be people, and I know a few of these, that I'm going to strike while the iron's hot because appreciation is awesome right now. And you know what? I can deal with jumping in a mid 6 to a high 6 interest rate, even though I'm coming from 3%. Ultimately, I'm in a better position with that for whatever reason. That is happening. It's
The reason
very
why, actually, if we want to really understand it, you are the single reason why buyers can't buy. You, me too. I will say. Yeah, I will say this.
I'll take the blame.
The reason why
Good cop, bad cop we
there,
got going here.
the reason why there is no the reason why there is no inventory is because guys like Manley and myself. Why do you ask that? It's because when our clients call us and they go, Anthony, should I sell or should I hold? And I look at their portfolio and I go, well, why don't we just take a second out, pay all your debt off, rent it out? The renter's going to pay for that mortgage for the first and pay for the second. Now you got that extra 50,000 after paying all your stuff off, and now you're going to buy another house. So they're going to leverage the debt, not offset the debt. And most lenders, if they're worth their weight in gold, are advising their clients this. It's never good to offload debt. It's always good to leverage it. And that's what people are doing. And that's only because COVID. If rates were not in the 2s and 3s and they were normal in the 4s or 5s, you better bet Betsy they would be selling, because it's not that big of a stretch to replace a 5% rate with a 6% rate. But it is a big stretch to replace a 2% rate with a 6% rate.
And in this scenario you're talking about, Anthony, what's happening is the inventory is not replenishing itself naturally because homeowners are taking their primary residence, turning it into a rental. They're looking for that perfect opportunity, and which is where we started in this conversation. They might not find the exact house that they're looking for, but they're going to find something very close, and they're okay with that because their existing debt that they had is being leveraged and being taken care of by a renter. And that's ultimately the rental market is strong right now. Rents are going up. And actually, this is a great segue because we got a question from the studio here from Kevin, and it's regarding renting. And so I think we should just take 2 seconds and pause for this and introduce Kevin Hansen, our super studio guy here. And Kevin, tell me a little bit about what you're thinking here.
Yeah, so I was just wondering, coming from renting, not owning at all, how, for example, my $1,500 a month rent factors into looking for a mortgage and how you guys factor that in.
That's a good question. Manley, do you want to take it or do you want me to start?
We can start with it, and then we can both jump in and talk to Kevin and talk about, in general terms, like your $1,500 is your current budget for your housing, right? That's what you're talking about. And that's a budgetary number. And so when I'm having the first conversation with the first time home buyer, I'm asking them, hey, what's your monthly budget? Because we might not be able to match 1,500. It's probably going to grow a little bit because there's more to it. You have your principal and interest payment. You have your homeowner's insurance payment. You have your property tax payment. And then you might have mortgage insurance because you put less than 20% down, more than likely. So all those things, that's your all-in number. And so I try to talk it through with you, Kevin, and understand, hey, we could look at $1,500 to match, but is that really your goal? And then we talk about, okay, what is your range? Could we get you up to 1,800? Are you still feeling like you're comfortable with it? How does that go? And then we shift the conversation and talk about, and we've talked about this before, you're buying an asset now at this point that you get to live in. And so with your $1,800 payment, you're buying somewhere between a $325,000 home and maybe $280,000 to $325,000, somewhere in that range. But that is going to continue to appreciate at a rapid pace of somewhere between 6 and 10% annually. And everything we're talking about here, this appreciation factor is growing, and it's going to continue to grow as more buyers become available to the marketplace when rates do work their way down. But, the big picture item is the $1,500. How does it equate today? It's a budgetary number, and you have to be comfortable with that budgetary number. But to increase your personal wealth and start your own physical piggy bank, you need to jump in. The longer you wait, the less appreciation you're going to realize. The less that this money is going to work for you, this $1,500 or $1,800 or whatever it may be, it's going to work for you on a monthly basis. So, jump in, Anthony.
So that's a PhD level. So for all you college graduate PhDs, you probably were like, oh yeah, Manley, for sure. Oh yeah. But people like myself who are not the sharpest tool in the shed, I guess you could say, we're just kind of like, what did Manley just say? So for all those people listening, I'm going to break that down to you. So basically, Kevin, what I'm hearing is this: you have an understanding of what you can afford in the present state, meaning you're paying $1,500 a month. But I guarantee you, if I sent you an app that could create a pie sheet of what expenses and bills come out of your bank account, and you can show food, entertainment, bills, you're going to see like 50% food and entertainment, which equals warm and fuzzy, meaning this is my comfort zone. Whereas if you take that food and entertainment, I'm not saying top ramen and crackers, but I'm saying you can condense
hot dog soup tonight.
25% of that, and maybe you can afford a $2,200 mortgage with some tweaking once you understand fully what you're working with. And yes, you're going to have a higher mortgage payment, but you're investing in yourself. It's a pain point that's necessary for financial growth. Whereas if you are expecting to grow financially without any pain, that is called robbing a bank or OnlyFans. You either have to rob the bank or you need to be an OnlyFan. And that's
putting up his site shortly on the screen.
But I mean, it's the definition of growth is from the Latin word grauth, where it's uncomfortable. So you have to understand that you have to become uncomfortable in order to grow financially. So you're not going to find that, apple to apple, 1,500 rent, 1,500 mortgage. You can find that, but it's going to be a condo or a townhome. So I think the big thing for you, Kevin, is to understand what pain points you're willing to negotiate and what are your non-negotiables. Really sit down and go to these, it's like top 5, these apps that will allow you to really look at your finances, say, where's my money going? And then you can understand what your priority is. Is my priority Chipotle or Starbucks every day? Or is my priority amortization schedules of appreciation and tax write-offs and paid down principal in the form of a mortgage payment where you're not making a landlord rich? That's the questions you need to be asking yourself, Kevin, to really understand what that's going to look like for you.
Awesome.
Well, hey, thanks for that help there, Anthony. And Kevin, I hope we can get you at one point to take a serious look at all this. So thank you very much. Hey, Anthony, we got this unbelievable product here at the company we work for, which is Rate, formerly Guaranteed Rate. And it's pertinent to what's happening today in the market. And I just want to get your feel on how is all this smart technology impacting the buyer's experience and the mortgage industry right now. I think it's great. I want to hear your take on it.
My take is visually and verbally. Time is money. And the more time we spend on things, the less money we can create or the less experiences we can create. And right now, time is important. We're going through so many changes in the world right now that people are really having a second look on going, do I really want to spend my time making someone else rich? Or do I want to spend my time, pushing experiences to my family that last a lifetime. Because again, I say it all the time, in 100 years, everyone watching this, including you and me, are going to be dead. All of our stuff's going to be thrown out or given away or in a box collecting dust. And other families are going to be eating in our kitchen. So you're going to plan, but you're planning for what? So there's no important time than now. And, if that's one thing that I could tell everyone, there's no important time than now, and there's no important reason than the now. Not the what if, not what's to come, because that could change. But what is really important is, how are you spending your time now? And is it being spent in a way where you see value in it? Or are you just behind a curtain or behind a laptop or behind somewhere living in the not has happened yet years, while your now years are just going past you? But that's the thing. It's time. That's the biggest component.
I think you're talking about setting your priorities that are time
Yeah.
related, but it's,
No,
prioritizing what you're spending your
yeah, like
time on.
with the applications now, it's smart technology has allowed us more time. The traditional way 5 years ago was you get in your Oldsmobile and you drive down to the brick and mortar, you get your coffee, you sit in the waiting room, you come in, and then you talk to you and me, and we sit there for 30 to 45 minutes and we go over your options and we give you a needs list. And you get back in your car, get in traffic for an hour, and you come back to the office, you give all your paperwork, we scan it, and you do that 3 or 4 times, and like 15, 20 hours later, voila, you're ready to purchase. Nowadays, as long as you have a smartphone, literally it takes 5 minutes to do an app, and within 30 minutes, you're fully approved, and within 24 hours, you're fully certified. And you didn't have to leave the comfort of your home. So that's
I,
technology.
I got a great example. 2 weeks ago, was at a Brewers game on Tuesday night. Had my iPad with me and was using Power VP, which is one of our great tools that we have.
Uh-huh.
Took an application for a $1.3 million property, banged it out at the game, told him I was at the game. He filled it out. 15 minutes later, it's all there. I was able to verify his income through documentation that he uploaded. I just took a quick look at it, validated it sitting there, called his realtor, produced a pre-approval, and I wasn't even in the seventh inning yet, explaining to both parties that, hey, this is coming from the Brewers game, so bear with me. You'll get your pre-approval. On my ride home from the Brewers game, I got the call. We got an accepted offer. It was a miracle. Without this technology that we're working in right now, to be able to, validate and verify and do Finicity, all his accounts, he linked to Finicity for me. And we had all these algorithms working to our advantage. The smart underwrite was in play. Boom. It was a $1.3 million purchase. That's a great opportunity here in Wisconsin.
Yeah.
That's a
I-
good size loan.
And I can't tell you how many times, I educate my agents, my agent partners. When you're going to put an offer, not only do you CC me so I can send a list of everything that's done and I send a video, but I'm like, hey, pick up the phone, call them, call me on three-way, let's have a powwow. And
Yeah.
so, and the more information we have, then the better we can set up our clients for success. Because I've always the thinking there's 7 other people on the side of us trying to get this house. What can I do to make sure that our horse passes that finish line first? And you'd be surprised the conversations we have. And like one last week, they were like, listen, like we got a lot of offers on this, but the sellers already have a house picked out and they're in escrow. So cash is our king, but we realize that we're not going to be able to get, the value we want if it's a cash offer. So we're looking at all other offers. And I said, hey, so and so, what if I can treat this like a cash offer and we can close in under 21 days and I can make sure the appraisal's back within 5 days and the loan contingency within 7 days? And they're like, well, yeah, that would be amazing. I'm like, well, the good news is that this offer is fully certified. Everything has been done. Income, assets, everything's done. That conversation made it to where they're like, well, I'm going to present this right now to them. And I said, even better, I'm going to send a video confirming this. So that way, not only is it coming from you, but you can show them that video. So I think time not only helps the user, the borrower, our borrowers, but it also helps their offer. Because if there's other people that are competing and they're able to skip the line or get a fast pass, so to speak, if this was Space Mountain, they're going to get on that roller coaster a lot faster than the other people because they're utilizing technology to their advantage.
Absolutely love it. Absolutely love it. And it's working for us every day. And that's part of what I love about the company that we work for, Guaranteed Rate. We have access to all these great tools, and not trying to plug these guys too much. I love them. It's over my shoulder there, up other shoulder. Um, but it's wonderful what we can do. And, both those stories are amazing, what we were able to accomplish in a very short period of time. But anyway, there is a massive movement out there right now of some non-traditional lending that's happening that's doesn't quite fit in the rules of Fannie and Freddie necessarily, doesn't quite fit in the conforming world out there. Tell me a little bit about what you know about that, because there's some products out there that are pretty amazing that are crossing the lines and stepping into that field because of why? Because they're easier to use and because there's less documentation. Even in this world and all the smart underwrite we were just talking about, there's still borrowers out there that need that kind of facilitation to make it easier for them to prove their income to support what they're trying to do. Give me your 2 cents on how we make that work.
I mean, there's reasons why what we call it in our business, the non-conforming or the alt doc, because we don't conform to the guidelines of the central bank, FHA, VA, Fannie,
We're
Freddie.
not talking about subprime stuff again, are we?
Oh, not the you got a pulse, you're approved.
Okay,
2007.
just making sure. Just wanted to touch base and see if Anthony's slinging some crazy paper out there in Hawaii. I know it's crazy out there, but
Hey, your cousin Vinny or your uncle Guido in the back. Hey, I got a loan for that. This is not 2007, folks. This is not you got pulse, you're approved. Like they got us into the ugliness that they have. We Loans nowadays are the most scrutinized underwritten loans in the past 30 years. There is so much red tape and regulation. They do not just give loans anymore. You have to have good credit. You have to have a good debt to income ratio. You have to have good loan to value. You have to put money down. There is no 100% financing high risk loans. There's not. If there's 100% financing, it's two things. It's either VA or it's down payment assistance. That is it. There is not these, hey, I can't show my income on paper and I don't want to be anything out of pocket. Now, here's the caveat to that, Manley. A lot of
wait,
people.
did you say you have to show your income?
Oh, you do not. You
Okay,
do
let's
not.
hear it. Sorry for
So,
interrupting again.
yeah, no, hey, you know what? These are good questions, Manley, and they have to be answered by people like us because we're in the trenches. And so we understand this. This is not your mom talking at a, knitting, ceremony or a birthday
When we
party.
got a loan back in 1972.
We are in the trenches. And I'll tell you this, a lot of people don't show income by design because they have this uncle, his name is Sam, and he likes money and he likes when people make money. Because remember, during our last podcast, we've learned that debt equals income and income equals debt. When we make income, we create debt. When we generate a debt position, we create income. That's the trick. So a lot of people make a lot of money, but not on paper by design because they have write-offs and they have expenses because they would much rather get a debt position from that income and not an income tax. So
I think we're talking about self-employed people pretty much, right? You're not talking about the W-2 guy like me, which is unfortunately Uncle Sam loves me. But
you have two different types of buyers, Manley. You have employed, self-employed. That is it. Employed, self-employed. If it's employed, full doc, W-2, pay stubs, all that good stuff, verification of employment. If it's self-employed, no W-2s, no pay stubs unless you pay yourself, but we still need what? Tax returns. If you're going to go full doc and you're self-employed, we need 2 years of tax returns if you've been in business for less than 5 years, or 1 year tax return. That is conforming. But if you come to me and go, hey, Anthony, I make $1 bazillion, but not on paper, there's a loan for that. You can do a no-doc loan, otherwise known as a
Whoa.
P&L loan.
Oh my gosh, we're sounding like we're in 2007 again, Anthony. You're scaring me.
I got a bank statement loan. You got no taxes, bank statements for the last 12 months. You got it. Use an expense factor of 15%, 85 cents on the dollar. You got it. Don't have bank statements, but you only have a P&L from your CPA. I got that. Don't have a CPA or nothing, but you want to buy an investment with absolutely zero income. DSCR, debt service coverage ratio. It's the best
One
loan
more
out.
time. One more time. I missed
DSCR, debt service coverage ratio. Okay.
Thank you, sir.
That means it's the income that's based off of the asset and not the person. How does that work? Easy. Say you have a house that you're buying for $1 million and you put 25% down or 250,000. And say you do a 40-year fixed interest only and the payment is $5,000. But the rent is $5,500 that you're going to be getting, that we confirm from an appraisal. It's not the existing rental, it's the future forecasted based off of the area that it sits in. As long as that rent meets or supersedes what the mortgage payment is, that is the income qualifications. We even have 75 cents on the dollar under that. If you have, say, $1,000 mortgage and the rent's only $750, there's still a loan for that. It's a no-doc loan. It's a true doc loan. But as you talked about, there are loan options out there that, whether it's by design to try to not have tax ramifications, or whether it's just the type of business you're in. If you're in a tipping industry, if you're a bartender, or if you're in the customer service industry, or if there's always a reason of why the paper is what it is. It's up to you and I to figure out the easiest solution to homeownership.
The interesting part about the DSCR loans currently is that these rates are competing with the conforming investment properties because of LLPAs. This is getting deep in the weeds, by the way. Sorry. LLPAs were thrown at us from the previous presidency. They're basically, fee impacts to interest rates for investment properties or second homes because they didn't want those folks to get the same cheap money that a primary residence was. And I'm not trying to get political with anybody, but it changed the landscape a little bit. So it opened up opportunities for these type of products specifically so that you can go out and compete, but yet these products really lend themselves to professional investors that have multiple properties. And you can go and this is a great opportunity. You can refinance up to 75% of that out, do a cash out refi using the same product, the same methodology that Anthony talked about. And you can pull the cash out and you can go buy another house, another rental property. Now, again, this is that magical leverage thing that I keep talking about, that I talked about with Kevin. I've talked about in other podcasts, that you are growing your asset base. And if your asset base started at $800,000 in property, and I was able to turn that into, 1.2 million dollars, and they're both appreciating at somewhere between 6 to 8%. That's a no-brainer.
But Manley, Grant Cardone says never to buy. Dave Ramsey says don't get into debt. We have to listen to these deities. Grant Cardone, he knows what he's doing.
He's a smart feller. He's a smart feller, but
he will agree with me. It is very bad to buy. You need to rent. That's his mantra. And Dave Ramsey, same thing. God bless him, but his whole mantra is you don't get into debt unless you can pay it 100%. So until you can pay that $500,000 for that house, the viewers out there, you should be renting, because that's smart and prudent.
Sorry, I don't agree with all that. I'm not saying they're wrong, but in this circumstance and what we're talking about, there's good leverage and there's bad leverage, and everything we're talking about is good leverage, and it's smart business, opportunities here to do this. And back to the question, the product's great.
Math is math. Math is math. And if you look at it in a one-dimensional, yes, it's a debt. But if you look at it four-dimensional, what is that debt doing? There's a reason why the millionaires, when they make 5 million in a fiscal year, they try to find 5 million in debt to offset it. You don't find millionaires that are just paying cash for everything. In fact, a lot of my clients who are very high net worth, being licensed in a lot of the high net worth states in Hawaii and Florida, Texas, California, they have tens of millions of dollars in their bank account and they can pay cash. Why would they do that? Because if they're earning all this income and they have no tax shelter or they have no debt position, the only person getting rich is the government. They understand that debt
There's
equals
Uncle
income.
Sam again. There's Uncle Sam coming to the picture.
It is. It's listen, real estate is the normal man's way of being a bank. Because when you give a bank $1, they turn around and create a debt position of $10. So they are creating a debt position off of income. The same thing goes with real estate. You are taking that debt position and creating income in the form of every time you pay a mortgage, you're paying down the principal with the renter's money. You're gaining appreciation with the cumulative appreciation per year. You have the tax incentives and all the write-offs and all the maintenance costs. And then you have a cash on cash when you decide in 3 years to make it a rental. And now you're making cash on flow. These are things that they don't teach you, because the more you don't do, then the more that Grant Cardone and the other ones can rent to you.
It's interesting, and you're right up my alley with this whole thought process. And the math tells us what to do. I'm not suggesting anybody over leverage themselves. Leverage is important, but understanding where the tipping point is also important, and that's where the math will speak to you, and let it happen. So that's a great segue into our next one. Is are we going to see the market slow down? Is there something we need to worry about here? I mean, do you feel like we're still in this possible doomsday market crash?
Let's look at the facts, right? Because facts matter, right? Facts matter, right? So, um, you know, one, when you look at 62% of loans right now, they're under 3.5%. They ain't moving anytime soon. Two, you have the CARES Act of 2018 that now banks have to do deferments, modifications, forbearances. They can't just pull the rug under you and short sale foreclosure anymore. They have to work with you. It's a federally insured loan, which 90% are, unless it's a jumbo. But even then, they don't want that on their books. So are we going to get this exodus of short sales and foreclosures? No, because people are going to have some time to breathe. On top of that, they're swimming in equity. Back in 2007, they were up their eyeballs and they had no equity, or the house was so expensive and all the equity was eaten up. That's not the case now. People can lose half their equity and they'll still have equity. So there's not this doomsday. When you look at debt cycles, we're about to go into a new debt cycle. And when new debt cycles emerge, new credit positions emerge. It's easier to get credit. Less than 5 years ago, we were doing 3% down jumbos. That's because the debt cycle was in its infancy state 5 years ago. And banks were just like throwing money to lend because they knew that they're going to make money at the end of the debt cycle when interest kicks in. Either they're selling it or they got all their money in their prepayment penalties. That is not the case now. We are not going to see this exodus of supply. We're still going to see the demand continue to go up because of the rates. There's not going to be a whole bunch of houses being built over the next 5 years. Just look at the books of D.R. Horton and Richmond American and Toll Brothers. They even are saying, listen, we're on a pause to make sure that we're not going to overstep our bounds here. And we're only going to see rates go down. Powell said it. Are we going to see rates go down next month? Probably not. Are we going to see them go down this year, next year? 100% yes. Do we see inflation in check? Yes, we're under 3%. Are we at that 2%? No, but we're headed in the right direction. These tariffs are making it, transitory, but they will pass. Once you take this tariff issue, which it's only a negotiation tactic, once that comes off the plate, and, I want everyone who's listening to think of the market as right now we are on a runway and we're getting ready to take off. But we can't take off because it's cloudy. So we can't see the runway ahead of us. So we can't launch because we don't know how far of runway we have. The problem is you look behind you and the side of you, and there's thousands of planes packed full of people going, I just want to buy. Once these clouds dissipate, it's just going to be a launch pad of so many people going into the market. And that's what the feds are afraid of. The feds are afraid of the exact situation that we're in. They did not want historically high rates and historically high uh, everything at once. The problem now is they have to be selective with the rates, because if they make the rates go down too fast, then that's going to cause home prices to skyrocket even more, and that will definitely cause a bubble. So they have to make it a marathon, not a sprint. These rates are going to take
It's a
3
slow
years.
measured pace. It's a slow
It's a
measured pace. It has to.
it's not going to be overnight, but what you don't want to do is wait till everyone else gets to the party. You want to be 2 steps ahead. It's called being ahead of the curve. The curve is right around the corner, and everything is showing signs of it.
Back to the beginning of our conversations, and what you're talking about is the impact of the volatility of the bond market is exacerbating the situation right now and making this even more difficult for the interest rates to come back down, because we're fighting basically a ceiling of bond, fluctuation that's creating a little higher rates than we had 3-4 weeks ago.
You make a
We're
good point though, Manly. Like, wait a minute, the stock market is like tanking. Why isn't the bond market rallying? Why, how come we're not seeing everyone, huddle to the bond market? Because typically when the stock market collapses, everyone huddles to the bond market. That's good for the rates. What's
not
going on?
happening. Not happening now. Not happening now. It is because people are selling treasuries, and the overseas buyers who buy a lot of our bonds are not buying it in the same way. They're not feeling like it's a safe haven because
Uh,
of the tariff situation, and that's what's making it temporary. So when this
it,
tariff situation sort of flattens itself out, levels itself off, and we get a clear picture in the clouds part, then we'll see the bond market go back to a sense of normalcy, probably come down. Again, it won't be a plummet. It'll be a slow grind down to rates that are in the mid sixes, down hopefully in the next 12 to 24 months to pass through the 6% into the five handles. That's a prediction. I don't have a crystal ball, but and that will help us get everybody prepared for what's to come. So
did you just say that 31.6% of bondholders are foreign? And
well, it's in that range. I wouldn't say 31.6 exactly, but we're right in that range, and it does have an impact. And the tariffs is scaring everybody overseas.
that makes complete sense, and it is 31.6 as of 2025. But just to be exact, you make complete sense, because the fact that these tariffs are making people uncomfortable, they're not really sure where to park their Buick. And so we're seeing a lot of movement going on, and that is creating uncertainty. And mainly, do markets like uncertainty?
They do not like volatility or uncertainty, and
And
this
what
is where
happens
we're getting
when there is volatility? How do they position themselves if it is?
one more time. I missed it, sir.
If there's volatility in the market and uncertainty, how does the market position itself? Offensive.
Typically it all runs to the bonds, to a safe haven. And unfortunately, we're not having that because of this tariff situation. So we are in an anomaly based on the uncertainty of the tariffs. So the stock market doesn't like it, and the bond market doesn't like it. And our overseas buyers are fleeing from the normal, safe haven of the US bond market. And here we sit. This too shall pass. Volatility, is creating opportunity. And it'll
And
happen.
I'm gonna go down a rabbit hole just for people to understand of like, well, what's next, right? A lot of people are shaking their heads, going, "What's next? What's the next move?" Well, it's real simple. The problem is, now that people are taking their money out of the stock market, which 41% is foreign owned in the stock market, 31% in the bond market. If they're taking their money out, and the problem is that they can't put it in another position, because those positions are also seeing massive losses, whether it's, Japan's market or China's market, or, British, UK's market. So the problem is we have the limbo effect, where people are kind of just hovering and they're not landing. The good news is the there's a high probability that everyone's going to land back onto the Mother Earth, which is US. Because why? Because the dollar is the standard. And so they're going to want to go to the standard, because if our dollar is being devalued, everyone else's dollar is devalued. Why? Because their debt is held in it. So it's brilliant, the fact that we set it up that way, but they can't have their cake and eat it too. So I do believe that it's temporary, like you said. I do believe that once the chests that are puffed out will subside, and once the opinions are mitigated, then, in the next, we have 70 days left for everyone but China for these 90-day tariff pauses. They're going to come together to the table. They're going to have more common sense tariffs. And what's your stake on China? You think that's going to be done in 90 days, or you think that's going to be the elephant in the room?
I feel like that's going to continue to be the elephant in the room, only because of the posturing that's occurring right now. So at some point, somebody's going to have to give, and there's a little bit of chicken going on, folks. And we're gonna see what happens. I don't want to take this too political here, but that's the reality of it, and that is continuing to create the uncertainty in the bond market, which is why the fluctuation, because China has a big impact on us, and we have a big impact on them. So,
and I'm glad you said not political, because at the end of the day, us as professionals, we have to take politics out of it. I mean, we have to just follow math, and we have to follow statistics, and we have to follow trends. We have to follow guidelines, and that paints us our Picasso. Right now, we have two of the big superpowers. We have China and US that are posturing up against each other, and the only end result is higher cost to the end user. Now, the thing is we need to know, is that temporary, semi-temporary, or is that the new way of life? Now, if it's the new way of life, I promise you things are going to be changing, so that way the effects aren't felt. Do I think it's going to get to that point? As our number 2 pencil is going to be, not, made in the US anymore. I do think that they're going to come to the table, just like you said. I don't think it's going to be 90 days with China. I think it's going to be more like the entire year. I think at the end of the year, hopefully they'll be done posturing. But the big thing is the rest of the world, I think, is going to come to the table, come up with common sense tariffs, not only for their own country, but for us as well as Americans. And we can get back to what we do best, which is, doing the American dream, not, being a gerbil and just putting everything away and having our quality of life diminished. It's about, creating a quality of life for our loved ones, creating home ownership, creating possibility and opportunities. Otherwise, people thought wasn't in existence or possible. And we can get back to focusing on that and not all of this other stuff.
Yep. Well, hopefully that's around the corner sooner than later. I hope it doesn't last a full year. I am truly hopeful that the positivity that will come from the rest of the nations coming together and minimizing the tariff impacts on each other will have a hand in what happens between the U.S. and China. So that's my hope, and I can't base my life on hope. Got to figure it out, but I'm hopeful that that'll happen, and I'm thinking positively, and I'm a true believer in the power of positivity, and so I'm going to stick with that for the moment.
And no matter what, at the end of the day, regardless if the China trade wars and other wars are going to be here temporary or here for the next 20 years, at the end of the day, we still need a house to lay our heads on. We still need a place to call our own. We still need a dwelling, and that's never going to change.
And I believe the American dream revolves around housing. I really do. And I believe that it's in everybody's best interest, if they can humanly possible, get into the housing market and own their own home, that's the best opportunity for personal wealth growth. So I'll depart with that. We've gone down a lot of paths here today, and I love every one of them, and appreciate all your insights. And I like that you let me poke at you and ask you some direct questions and get your response. I appreciate that very much.
I appreciate your insight. It's a wealth of knowledge, and it's really good. We get your expertise, and then we get me to be able to dumb it down for us regular folk, so that way we can understand, what the heck we're doing when it comes to mortgage. That's why we're the Mortgage 101 podcast. We want to understand what's in this trenches, what's the current events, what's the pain points, and more importantly, what's stopping people from becoming homeowners. So that way we can overcome it.
Hopefully somebody picked up a nugget on this today on, what they can do in the home buying process and what kind of products are out there and available, what's happening in the marketplace right now. This is going to be ever changing. So that's why we're going to continue to do shows and try to educate you guys. But Anthony, I appreciate you very much. And I appreciate our studio guy, Kevin Hansen. Without him, the lights don't really go on and the cameras don't really work the same. Our link up all the way from Wisconsin to Hawaii gets a little shuttered and crazy. We're not using tin cans on a string. We can't get the string to go that far right now. So, but no, I love it and I appreciate it. And glad everybody here listened to the Mortgage 101 podcast. Go check us out on YouTube if this is where we're at. And we're on Spotify and Apple too. Looking forward to seeing you guys again. Thanks a bunch. If this episode helped you feel more confident about your home buying journey, do us a favor. Share it with a friend, subscribe, leave a review, and if you've got a question or a topic you want us to cover, hit us up with a DM or a comment. Thanks for listening to the Mortgage 101 podcast. We'll see you next time.